Hello traders, you are welcome to this video and you are welcome back to the Forex Geek channel where we dive deep into effective trading strategies, tips and tools to help you make the most of the Forex market. So in this particular video, we are going to be covering uh, you know, an incredibly powerful combination that can level up your trading game. And what we're going to be discussing is the 200 EMA and the stochastic oscillator, a very nice combo. All right. Whether you are new to trading or looking to refine your skills, this combo can provide you with a good trend direction and entry signals. So let us get into how you can use the 200 EMA and stochastic indicators together in your trading strategy. And hey, if you are enjoying the content, don't forget to hit that like button and subscribe so you can stay updated on our latest videos. Let us jump in. Okay, so let us start with the 200 EMA. I'm just going to be adding the 200 EMA to the chart. We can see period 200 EMA method exponential. You can just leave this apply to close and you select the color that you want. Okay, and here we go. All right. The 200 EMA or the 200 exponential moving average is an essential indicator for understanding the trend direction in the Forex market. Unlike a simple moving average, which takes a standard average of past prices, the exponential moving average places more weight on recent price action. This makes it more responsive to changes in the market. In Forex, the 200 EMA is often used as a benchmark to determine if the market is trending upwards or downwards. Okay, so when the price is above the 200 EMA, as we can see in this situation, that means we are looking at an uptrend. So it means that this is an uptrend. XAU USD is currently in an uptrend. All right. On the other hand, when you have price trading below the 200 EMA, you have price trading below the 200 EMA, it means that the trend is bearish, okay, or a downtrend. Now, many traders rely on this single line to gauge whether they should focus on buying or selling, depending on where the price is in relation to the 200 EMA. Now, you might wonder why we use the 200 EMA specifically and not, say, the 100 or 50 EMA. The 200 EMA is a popular indicator. The 200 period is popular with the EMA indicator, because it filters out short-term noise and focuses on the longer-term trend. This is especially useful for swing and position traders who want to ride larger moves, okay? But it's also valuable for day traders because it helps keep you aligned with the bigger trend direction. By staying in line with the trend, you increase your chances of catching moves with momentum behind them. So the 200 EMA provides a clear framework. If the price is above the 200 EMA, you might want to look for buy opportunities. If the price is below the 200 EMA, you might want to look for sell opportunities. Okay. Now that we have covered the 200 EMA, let's move on to the stochastic oscillator. All right, I'm going to be adding the stochastic oscillator to the chart. Essentially, the stochastic oscillator is telling us when an asset might be due for a pullback or reversal. Okay, an overbought condition, which is when the stochastic is above the 80 level, suggests that the price may be at a peak and could reverse down, while an oversold condition, which is when the stochastic is below the 20 level, suggests that the price might be at a bottom and could reverse up. So this gives you a potential entry and exit signal depending on the market's condition. All right. Now here's where things get interesting. Combining the 200 EMA with the stochastic oscillator, when used together, these indicators can help you time your entries more precisely while keeping you aligned with the market trend. The 200 EMA provides us with a trend direction, and the stochastic oscillator helps identify potential entry points within the trend. Okay, So here's a basic way to approach it. If the price is above the 200 EMA, it means we are in an uptrend. Okay, in that case, you would only look for buy entries. And when would you enter? When the stochastic oscillator is oversold. Okay, when it is oversold, meaning the value is below 20. For example, in this situation, and possibly signaling a reversal back up. This way, you are buying during a dip within an uptrend. Okay, increasing your chances of getting in at a good price. Conversely, if the price is below the 200 EMA, you only consider selling opportunities. You would wait for the stochastic to be overbought. All right, you wait for the stochastic to be overbought. For example, in this situation that is above 80, suggesting the price might pull back down. So you'll be selling after a small rally in a downtrend, aiming to capture momentum on the way down. All right, on the way down. Now, we can see that this is a clear sell example where we had price below the 200 EMA and we had stochastic oscillator in the 80 level crossing downwards. This would have been a good sell opportunity. We have entered the sell here, set to stop loss above the swing high. And then for our take profit, we can just wait for price to cut back above the moving average and we exit our sell. Or we can just use the nearest support zone to exit our sell. Okay. Then as for the buy trade, when we noticed price trading above the moving average, we just look for the look for buy signals when the stochastic oscillator is in oversold territory and cutting upwards. We enter buy trade, set stop loss below the swing low, and then take profit can be when the price cuts below the moving average downwards, or you can just use nearest resistance zones, to determine our exit for our buy trades. Okay, now as with any strategy, there are a few things to keep in mind. First, you should always manage your risk. No strategy is 100% foolproof, and market conditions can change rapidly. Using stop loss orders is crucial to protect yourself from unexpected moves. Okay, also, while the 200 EMA and stochastic combo works well in trending markets, it can give false signals in a ranging market where the price is moving sideways. All right. So it is essential to identify the market condition before you use this strategy. If you see the price bouncing back and forth across the 200 EMA, for example, in this situation, you can see that we had a ranging market around here. You can see price was bouncing back and forth. Okay, all the way from this point till okay, let us right. Okay, see all the way from that point till around this point, we had a significant consolidation, right? So I'm just going to be adding a rectangle to show that. Okay, so we can see we had a ranging market within this zone. Okay, so when the market is ranging, it might not really be a good opportunity to trade. Okay, using this particular strategy. Remember, practice makes perfect. So try this out on a demo account to get comfortable with it before taking it live. If you found this strategy useful, make sure to hit that like button and don't forget to subscribe for more trading tips and strategies. Join our community and get ahead in your trading journey. Thanks for watching and I will see you in the next video.